Welcome to The Explainer. Today, we're going to decode U.S. taxes for non-residents. And look, we're not just going to go through the forms line by line. We're going to get into the logic behind the rules, the why of it all.
So let's say you're not a U.S. citizen, but you're earning income here in the States. You need to know that you're playing a completely different game. Seriously, this isn't just about filling out a different form. It's like stepping into a parallel tax universe with its own set of rules. And trust me, understanding the logic of that universe is everything.
Okay, to really get a handle on this, we're going to walk through 5 key things. First, your IRS identity. Then, the 2 kinds of income, the deal with deductions, decoding the paperwork, and finally, some common traps you'll want to watch out for. All right, let's dive right in. First up, your IRS identity. Seriously, before you can even think about numbers or forms, you have to nail this down. Who you are in the eyes of the IRS is the foundation for, well, everything else. So here's the official lingo: non-resident alien. Your whole tax story starts with this label. And it's not something you get to choose, you know? It's all decided by 2 really specific black and white tests.
Now, one of those tests is called the substantial presence test. And forget about your visa type or why you're visiting. This is just a math problem. The IRS literally just counts the days you were physically in the US over the last 3 years. They take all your days from this year, plus a third of the days from last year, and a sixth from the year before that. That's it. It's just a numbers game.
And here's where things can get a little tricky. What if your status changes partway through the year? Maybe you got a green card in July. Well, then you become a dual status taxpayer. That means for part of the year you were a non-resident, and for the other part, a resident. And let me tell you, that creates a whole different, much more complex filing situation.
Okay, now we're getting to the absolute core of the 1040NR. I'm talking about the great income divide. If you only remember one thing from this whole explainer, make it this concept, because it drives everything about your tax bill. I want you to just forget everything you think you know about income for a second. For a non-resident alien, the IRS takes all your US income and splits it into 2 completely separate buckets. And how your money gets taxed depends entirely on which bucket it lands in. The rules for each are, well, they're night and day. And here they are, the 2 different tax systems living on one form. In one corner, you have effectively connected income. We'll call it ECI. This is basically money you earn from a US business or job. The good news? It's taxed with the same graduated rates as a US citizen, and you get to take deductions. But in the other corner, you've got not effectively connected income, or NEC. This is passive stuff like interest, dividends, rent, and this gets hit with a flat 30% tax. No deductions, no exceptions. It's simple, for sure, but man, it can be harsh. Okay, so this huge split in how income is treated leads directly to our next big point, the deduction disparity. This isn't some random rule. It's a direct consequence, a cause and effect relationship that comes straight from that 2-bucket system. And look at this. This is straight from the horse's mouth. The IRS instructions. No deductions are allowed against this income. This one rule catches so many people by surprise. That whole bucket of passive income, your NEC, it's taxed on the total amount you received, the gross amount. No subtracting expenses. Nothing. That 30% hits every single dollar. So yeah, it really boils down to a simple if-then logic. If your income is effectively connected, that ECI stuff, then yes, you can claim deductions against it. But if your income is not effectively connected, that passive NEC, then you cannot claim a single deduction, period. Your income type is literally the key that either unlocks or locks that door. Okay, so we've got the theory down. Now let's see how all these rules actually show up on the paperwork. This is where the rubber meets the road. The best way to think about the schedules attached to the 1040NR is not as a random pile of forms. Think of them as a set of specialized tools. Each one is designed to do a very specific job that flows directly from the tax logic we've been talking about.
So here's your basic toolkit. Everybody fills out Schedule OI. That's where you establish your identity, your country, your visa. Then, see Schedule NEC. That's your worksheet for that flat 30% tax on your passive income. And Schedule A, that's the dedicated spot for listing deductions, but only against your effectively connected income. You can see how each form lines up perfectly with the rules we've covered. Schedule P is a bit more specialized, dealing with partnerships.
Okay, let's wrap up by talking about the traps and special cases. These are the common pitfalls you really want to be aware of, because this is where the non-resident system gets, well, let's just say different.
This is a huge takeaway, so listen close. Filing as a non-resident alien means you get locked out of a lot of the common tax benefits that US residents get. It's not just a different system. In many ways, it's a much more restrictive one.
And here's what that looks like in the real world. Married?
Doesn't matter.
You can't file a joint return. You have to file as married filing separately. That head of household status? Nope, can't use it. Big tax credits like the Earned Income Credit or the American Opportunity Credit, sorry, off limits. Even the child tax credits are heavily restricted unless you're a resident of Canada or Mexico. It all adds up, and it can definitely lead to a higher tax bill. So, if we boil this whole thing down, it's a simple, logical chain. It all starts with your identity. That determines your income type, and your income type dictates the tax rules. Get that flow, and you've cracked the code to the 1040NR. And that brings us to a final, pretty fascinating question. What about tax treaties? Sometimes these international agreements can completely change the game. You could technically be a resident of 2 countries. A treaty might have a tiebreaker rule that lets you choose to be treated as a non-resident for US tax purposes, even if you pass that day counting test we talked about. And that, well, that can open up some very interesting planning strategies for people who know how to use it.